Singhal is in conversation with Marc Faber, straight from Marc Faber's house in Chiang Mai in Thailand. Let's go across and listen in.
Okay, let's now talk about various asset classes. Marc, of course, has predicted the last US market recession quite rightly. He also predicted the big rise in the oil prices when we had the last big rally in oil prices. So let's ask him what he has made of the recent data points. Marc, the thought that comes to my mind is that you've been very critical of the U.S. Fed and the policy of
Yes.
printing dollars.
Not just the Fed, all central banks.
All central banks, and it's national television, so we can't say exactly what you said about what's the best use of that money. But do you get a sense that this could be unraveling sooner than later, and we might be close to a bit of a problem point for global markets?
Well, let's put it this way. Inflation shows up in many different things. You can have inflation in wages, and you can have inflation in commodity prices. You can have inflation in consumer prices, in wholesale prices, and you can have inflation in asset prices, where assets move up sharply. So if you go back to, say, 1981, Treasury bonds in the US were yielding over 15%. They're now down on the 10 years to 1.75%. They were at 1.43%. In Europe, we have numerous government bonds that sell at the negative yield. In other words, when you buy a 10 years German bond or so, you're guaranteed to lose a little bit of money. Not much, but a little bit. And actually 30% of sovereign bonds in the world, they trade at the negative yield. So we had this colossal asset inflation, which you are also familiar with in India in terms of real estate prices in Mumbai. And although the Indian stock market peaked out last March, it was a bit more than a year ago, at over 30,000, we came down to less than 23,000 in January, and now it's rebounded to slightly more than 25,000. Stocks since, say, 2003 have done very well in India. So everything has gone up in price substantially, and as you indicated, my sense is actually that we could have a period of asset deflation, where asset prices just don't perform particularly well. And we have some evidence. The art market in London and New York has weakened considerably. Not every artist, but most artists. Luxury properties, whether it's in the Hamptons or in New York City or in San Francisco, the very high end is no longer moving up, and in many cases it's actually down. Same for Mayfair in London and so forth. The high end is not performing particularly well. And stocks over the last 12 to 24 months, if you take a global index, haven't performed well.
Okay, that's the word coming in from Marc Faber from his very